Gold's meteoric ascent in 2020 comes as investors move funds out of risky assets to seek better returns.
The low interest rate, the heightened geopolitical risk around the world, currency devaluation around the world, and also the risk sentiment, it's very beneficial for gold.
Prices are down some 6% since hitting the record high. But in the coming months, State Street Global Advisors thinks that gold could rebound to around $2,100 per troy ounce.
Historically, Q4, it's always been very benefit for gold prices. So there has been some seasonality when gold price do spike towards the year end because investors do rebalance the portfolio.
For Phillip Futures, it sees gold prices riding even beyond $3,000 per troy ounce.
For end of this year, possible target is 2002 to 2004. But by next year, if this rally continues, which I believe there's strong reason to, it may even reach 3001, around that area. We have not even seen the full swing from gold prices, starting from maybe the 2000s. That's when gold price was 200. So until when gold reached its last high of 1900, we're talking about a 1700 move. And over a long stretch of time, we could see a similar move this time round.
The rally in the yellow metal has seen gold-averse investors like Warren Buffett's Berkshire Hathaway betting on gold mining firms.
Warren Buffett is a very conservative investor, and he always looking at value of the stocks. Gold does not give you interest, and you have to find a place to store them. And a lot of people think that this is counterproductive to putting some money in these investment cards. But look at gold at this time, it performed better than the other asset class, and it's very liquid.
Globally, demand for physical gold stands at around 4,000 tons a year. Half is used for gold jewelry. 10 to 15% is held by central banks as reserves. 20 to 30% goes to private investment, and the rest goes to industrial use, such as electronics production.
Over the last 15, 20 years, the size of the Asian market become bigger. And India, China, and Southeast Asia together, we consume almost 70% of the global current year productions.
During Singapore's circuit breaker, online bullion dealers were inundated with orders, says the Singapore Bullion Market Association. And in those months, pent-up demand and transportation disruptions pushed prices higher by 5 to 10% in the city-state. Overall, the global economic slowdown has hurt consumer demand for gold this year. But inflows into gold-backed exchange-traded funds have helped lift gold prices.
If I look at the past 20 years, the CAGR, the annual growth of gold, it's about 8.5% return. That's actually outperformed global stocks or global bonds. They have around 5% return for the last 20 years. And if we look at the US dollar, it's actually down from 20 years ago.
The SPDR Gold Shares ETF, which is among the largest exchange-traded funds globally, saw its physical gold holding rise by 40% year to date.
It's about 1250 tons right now. So it's not close to record yet, but it's very close to the level we saw back in 2011.
The ETF, which is also listed in Singapore, has attracted 1.6 billion Singapore dollars in retail and institutional money so far this year.
Year to date, the SPDR Gold Shares ETF has added 28% in Singapore dollar terms, and this adds to its 17% gains back in 2019. It also means that this has been the best performing ETF of all the actively traded ETFs that are listed here in Singapore.
The SPDR Gold Shares ETF is backed by physical gold and offers retail investors a simple and cost-effective way to invest in the commodity.
Over the first 8 months of 2020, its average monthly turnover was in excess of 160 million Singapore dollars, which is in effect triple of what the monthly turnover was for this ETF back in 2019.
That aside, gold is far from becoming a mainstream asset class. But with fewer speculators and more strategic investors piling into gold, some say that could change.
Less than 1% of investors globally owns gold. So I think potentially going forward, there will be more investors buying into gold because our recommendation for investors is to hold somewhere between 2 to 5% or 10% in the portfolio.
For now, the risk of COVID-19 resurgence and economic uncertainty will continue to drive gold prices higher. Still, some caution about getting overly bullish on prices.
You've heard of expectations of $5,000 per ounce. That seems very pessimistic. That would imply that the world's economy is really going to do very badly. That would imply that global central banks really need to bump up QE further, which is already at extreme levels.
The US Federal Reserve has increased its balance sheet by $3 trillion in the past quarter. And the jump in US money supply has weakened the US dollar, which benefits gold.
By the end of the year or early next year, the DXY will drop towards basically 90. You're not going to have a big collapse in the US dollar anytime soon, simply because it is still the world's #1 reserve currency.
With prices on the uptrend, is gold becoming too expensive to get into now?
There's this fear to enter the market right now, but ultimately you just need to fall back on your investment concept, your investment horizon, your risk management. How do you actually plan to enter the market, whether it's a one-time event or you plan it out over several occasions. When a product is trending, it will just keep breaking new highs. So it's only in hindsight then you realize that the last high wasn't that high after all.